Fibonacci retracement is used in technical analysis to find support and resistance levels after a strong price move. It's based on the Fibonacci sequence, which helps traders estimate where a price may pause or reverse. Forex traders often use these retracement levels to help decide when to enter or exit a trade. By marking key percentages on a price chart, Fibonacci retracements can highlight areas where buying or selling pressure may appear. Keep reading to learn how it works and how traders apply it to identify potential support and resistance after major price moves. What are Fibonacci retracements? Fibonacci retracements identify key levels of support and resistance. Fibonacci levels are commonly calculated after a market has made a large move either up or down and seems to have flattened out at a certain price level. Traders plot the key Fibonacci retracement levels of 38.2%, 50%, and 61.8% by drawing horizontal lines across a chart at those price levels to identify areas where the market may retrace to before resuming the overall trend formed by the initial large price move. The 50% level is not actually part of the Fibonacci number sequence, but it is included due to the widespread experience in trading of a market retracing about half a major move before resuming and continuing its trend. A bit of history of Fibonacci. Before we get in too much about what Fibonacci is, let's first answer the question, who is Fibonacci? Leonardo Pisano, or Leonardo Fibonacci as he is most widely known, was a European mathematician in the Middle Ages who wrote Liber Abaci, Book of Calculation, in 1202 AD. In this book, he discussed a variety of topics, including how to convert currencies and measurements for commerce, calculations of profit and interest, and a number of mathematical and geometric equations. However, there are two things that jump to the forefront of our discussion in today's world. First, in the beginning portions of Liber Abaci, he discussed the benefits of using the Arabic numeral system. At the time, the influence of the defunct Roman Empire was still strong, and the preference of most European citizens was to use Roman numerals. However, in Liber Abaci, Fibonacci provided a very powerful, influential, and easy-to-understand argument for using the Arabic numeral system. From that point on, the Arabic numeral system got a strong foothold in the European community and soon became the dominant method of mathematics in the region and eventually throughout the world. It was so strong that we still use the Arabic numeral system to this day. Forex strategies utilizing Fibonacci levels. Each trader's strategy will be different, so as an investor, you need to consider how each of the strategies below might fit into your overall angle on the market. Not every trader uses the options below, and it is all right if none of them align with your strategy. Strategies that utilize Fibonacci retracements include the following. You can buy near the 38.2% retracement level with a stop-loss order placed a little below the 50% level. You can buy near the 50% level with a stop-loss order placed a little below the 61.8% level. When entering a sell position near the top of the large move, you can use the Fibonacci retracement levels as profit-taking targets. If the market retraces close to one of the Fibonacci levels and then resumes its prior move, you can use the higher Fibonacci levels of 161.8% and 261.8% to identify possible future support and resistance levels if the market moves beyond the high or low that was reached prior to the retracement.
In this video, you can understand and learn about Fibonacci and topics. Detail of all topics of Fibonacci are following this in one by one. What are Fibonacci retracements? A bit of history of Fibonacci. Forex strategies utilizing Fibonacci levels. Different trading styles. Why Fibonacci works in trading. How to use Fibonacci in your charts. How to use Fibonacci retracements. Finding Fibonacci retracement levels. The significance of Fibonacci's golden ratio. Decoding Fibonacci retracement levels. How to effectively use Fibonacci retracements in trading. Avoid these common mistakes when using Fibonacci retracements. Common errors when using Fibonacci retracements. Inconsistent reference points, a major trading error. Identifying Fibonacci retracement mistakes, how to get better. Historical charts and backtesting. demo trading, forward testing, multi-time frame analysis, risk management tactics when deploying Fibonacci levels, how Fibonacci retracement helps you spot support and resistance, step by step, drawing retracement on an uptrend, step by step, drawing retracement on a downtrend. Would you like me to summarize the key trading strategies mentioned under these headings?
Different trading styles. Almost all traders have a trading style or set of strategies they utilize in order to maximize profit potential and keep their emotions in check. The Fibonacci trading strategy utilizes hard data, and if a trader adheres to their strategy, there should be minimal emotional interference. The Fibonacci trading strategies discussed above can be applied to both long-term and short-term trades, anything from mere minutes to years. Due to the nature of currency changes, however, most trades are executed on a shorter time horizon. Why Fibonacci works in trading. Fibonacci retracement levels work on the theory that after big price moves in one direction, the price will retrace or return partway back to a previous price level before resuming in the original direction. Traders use the Fibonacci retracement levels as potential support and resistance areas. Since so many traders watch these same levels and place buy and sell orders on them to enter trades or place stops, the support and resistance levels tend to become a self-fulfilling prophecy. These levels work largely because so many traders are watching them. When enough people believe something will happen in the market, they often make it happen through their collective actions. Traders use the Fibonacci extension levels as profit-taking levels. Again, since so many traders are watching these levels to place buy and sell orders to take profits, this tool tends to work more often than not due to self-fulfilling expectations. Most charting software includes both Fibonacci retracement levels and extension level tools. How to use Fibonacci in your charts. In order to apply Fibonacci levels to your charts, you'll need to identify swing high and swing low points. A swing high is a candlestick with at least two lower highs on both the left and right of itself. A swing low is a candlestick with at least two higher lows on both the left and right of itself. You got all that? Don't worry, we'll explain retracements, extensions, and most importantly, how to grab some pips using the Fibonacci tool. How to use Fibonacci retracements. Let's talk about Fibonacci retracement levels. Fibonacci retracement levels are horizontal lines that indicate the possible support and resistance levels where price could potentially reverse direction. The first thing you should know about the Fibonacci tool is that it works best when the market is trending. The idea is to go long or buy on a retracement at a Fibonacci support level when the market is trending up, and to go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. Fibonacci retracement levels are considered a predictive technical indicator since they attempt to identify where price may be in the future. The theory is that after price begins a new trend direction, the price will retrace or return partway back to a previous price level before resuming in the direction of its trend. Finding Fibonacci retracement levels. In order to find these retracement levels, you have to find the recent significant swing highs and swing lows. Then, for downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, do the opposite. Click on the swing low and drag the cursor to the most recent swing high. Got that? Now, let's take a look at some examples of how to apply Fibonacci retracement levels to the currency markets.
The significance of Fibonacci's golden ratio. The golden ratio, especially the 61.8% Fibonacci level, is a key number in both nature and financial markets. In trading, this level often acts as a strong support or resistance point. For example, if the price retraces to the 61.8% of a recent rise, it might suggest that the price will continue upward, making it a good time to consider a buy trade. If it falls below this level, it might signal a downtrend, prompting you to think about selling. Decoding Fibonacci retracement levels. Fibonacci retracement levels are plotted on a chart as horizontal lines, marking potential spots where the price could stall or reverse. To use them, identify a key price move, whether it's a peak or a trough, and draw the retracement levels from start to finish. The key levels are 23.6%, 38.2%, 50%, and 61.8%. These act as possible support and resistance zones to watch as the market moves. While these levels aren't guarantees, they provide useful signals to help you decide when to enter or exit trades. You'll often see the market test a level several times before breaking through or reversing, giving you an opportunity to plan your moves. How to effectively use Fibonacci retracements in trading. To use Fibonacci retracements effectively, start by identifying a significant price move. For instance, after a strong upward trend, you might expect the price to pull back to a Fibonacci level before rising again. By drawing retracement lines, you can spot these potential levels. Pair them with other indicators like moving averages or trend lines to confirm your analysis and strengthen your trading decisions. For example, if a Fibonacci level lines up with a trend line, it can give you a stronger signal for entering or exiting a trade. This combination of tools can boost your confidence and help you make smarter trading decisions. Keep in mind that relying solely on Fibonacci levels might not give you the full picture. It's important to combine them with other tools and indicators for a stronger trading strategy. You can try out different approaches. Avoid these common mistakes when using Fibonacci retracements. Fibonacci retracement is a popular trading tool that has become a staple of technical analysis in the Forex trading world. It's an elegant tool that offers simplicity in training by incorporating the Fibonacci sequence and the golden ratio. Many traders believe that these phenomena mirror natural market behavior, and just like in nature, the Fibonacci sequence should also be useful in trading, as markets are like a living organism, constantly evolving and changing. Despite its widespread popularity, many traders fail to apply Fibonacci correctly and use it effectively in their trading. By listing the main pitfalls of using Fibonacci retracements and providing a guide on how to use the tool correctly, this guide will be a must-read for all traders who want to use the tool in FX trading effectively. Common errors when using Fibonacci retracements. Even with the right tool in hand, errors in its application are very common with the Fibonacci tool. Many traders often make mistakes in selecting the swing points, which are the foundations of Fibonacci retracement analysis. Mistakenly drawing the tool leads to incorrect results, and trading performance suffers. Among the common Fibonacci retracement mistakes is when traders misidentify the points or switch between different methods, using the candle's body in one instance and the body in another. The resulting retracement levels will be off. Trading decisions will lose accuracy. It is therefore critical to develop a consistent approach to drawing these lines.
Inconsistent reference points, a major trading error? Another big mistake traders make is using inconsistent reference points. Imagine drawing a Fibonacci retracement from the candle's high in one analysis and then from its close in another. Inconsistency is the biggest enemy of a trader, and it can shift the Fibonacci levels significantly. The support and resistance levels may fall at prices that are not supported by the broader market context, which is never a good thing in trading. The solution here is to decide whether you are using extreme price points of the candle, the wicks, and stick with that method for all your analysis. You could also use candle wicks for these points, but you have to stay consistent with your chase method for all analysis. Consistency builds reliability in your trading and Fibonacci levels. Identifying Fibonacci retracement mistakes. How to get better. When trying to improve your Fibonacci skills, it is essential to first be aware of your mistakes and shortcomings. The key here is to start a trading journal where you record every trade or trading analysis that involves Fibonacci retracements. Apart from doing a trading journal, it is a well-adopted method to ask yourself several questions. So, what are the mistakes when using Fibonacci retracements? Did I use the same method, e.g. candle wick or body, for all swing points? Are rat recruitment levels aligning with the long-term trend? Do other indicators also confirm the potential reversals at Fibonacci levels? Am I constantly adjusting my levels as the price changes? Your trading journal should answer all these questions, so ensure you write down all important data about your analysis, such as where you put Fibonacci levels, what the reading of confirmation indicators was, what the major long-term trend was, and so on.
Self-assessment is key in financial trading as it mainly involves psychological factors apart from technical skills and market knowledge. Historical charts and backtesting. Analyzing past price movements on historical data is where traders start to build and test their strategies. Without analyzing past data, you cannot be sure of your Fibonacci analysis. Look past the data and see where the price reversed the most and how you could catch that reverse for profits. Write down clear and objective rules for your trading method and test it on historical data, backtesting. Test at least 30 potential trades to collect enough sample size to conclude whether your analysis was viable. Demo trading, forward testing. If your strategy worked fine during the backtest and it produced profits, it is now time to check it on live markets. The best way to achieve this is to use a free demo account. Backtesting is often subject to overfitting, and it might not produce accurate results. To account for this challenge, traders use demo accounts and trade using their strategy to see how well it behaves in live markets. Multi-time frame analysis. If you want to make your Fibonacci skills even better, try to incorporate a multi-time frame analysis, where you also check and draw Fibonacci retracement lines on higher time frames, like 1H, 4H, and daily. Longer time frames tend to have less noise, and they generally produce better signals when compared to shorter time frames where market noise makes it difficult to generate consistent profits.
Risk management tactics when deploying Fibonacci levels. Fibonacci retracements are a powerful tool, but without proper risk management, they won't help much. Trading is all about surviving in the long run, and risk management is the only way to do so. Here is what to do. Always set a stop loss. Fibonacci levels can also be a powerful tool for determining stop loss placements. For example, in a long trade at a 61.8% level, a stop loss could be placed slightly below this level or the 78.6% level. Define your risk-reward ratio. You also need to define a risk-reward ratio for your Fibonacci strategy. Most commonly used is 1 to 2, but depending on your strategy, you could go even higher. Use proper position sizing. Position sizing is an integral part of risk management, and trailers shouldn't go beyond their risk appetite, meaning you need to control lot sizes in every trade to eliminate risk of ruin. Be disciplined. In financial trading, only disciplined traders make money. Stick to your strategy rules and never deviate from them for maximum performance. Use multiple confirmations for entries. Once again, ensure to use several indicators for confirmation of Fibonacci retracement levels. How Fibonacci retracement helps you spot support and resistance. Fibonacci retracement uses ratios from the Fibonacci sequence to mark likely support and resistance after a strong price move. Typical ratios are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Traders place these horizontal lines between a swing low and swing high to identify pullback zones where price may pause, reverse, or resume the primary trend. These lines serve as reference points for entries, stop-loss placement, and profit targets. Step by step, drawing retracement on an uptrend. Confirm the trend, verify that you have higher highs and lower lows on the time frame you trade. Identify swing low and swing high, pick the significant low that started the move and the peak that ended it. Apply the Fibonacci tool from swing low to swing high. The charting package will plot the ratios downward across the move. Watch the pullback. Price often reacts at 38.2% or 61.8%. Look for price action signals like pin bars, engulfing candles, or a bounce off a moving average before entering long. Set stops and targets. Place a stop loss a few pips beyond the next lower retracement or recent swing low and use extensions or previous highs for take profit. Step by step, drawing retracement on a downtrend. Confirm the downtrend with lower lows and lower highs. Identify swing high and swing low that frame the fall.
Apply the Fibonacci tool from swing high to swing low so ratios appear above the move. Use retracement zones as resistance for short entries and watch for bearish reversal candlesticks or divergence on oscillators. Place stop loss above the next higher retracement or recent swing high and plan targets using Fibonacci extensions or support zones.